12th. May's flying by. All right, let's jump on in. So we had a big update today on China Pause Day. SPY's up 3.3%, Q's up 4%, IWM up 3.5%. You guys can hear me, right? Oh, nope, you can't hear me. I didn't turn on the VTF. All right, let's try that again. I didn't do the disclosure either. All right, restarting. I didn't even have the radio on for the virtual trading floor. You guys there? Good afternoon. All right. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There's the position disclosure. It's basically the same. It just had some options expire worthless last week. People in the YouTube got a little blooper episode there because I turned on the YouTube but I didn't turn on the VTF. So let's do it again. So SPYs closed up 3.3% on the day. Big up day. Big up, big up. Qs over 4%. Just over 4% on the day for the Qs. Sick. Big up day. IWM 3.5% to the upside. TLT notably weak. Down a percentage point. And, you know, the close is near some of the closing lows that we had throughout April and May so far for this TLT. Dollar had a big update today. That was probably nicely needed. Gold is down almost 3%. So people, you know, there's a bit of an unwinding on the fear trade today, right? Bonds selling back down, gold selling down, stock market having a big up day. And what did Bitcoin do? I'm not getting a percent for whatever reason, which just is what it is. So there it is. Oh, Bitcoin finished red. Okay, so Bitcoin went green to red during the day. I didn't realize that. I don't follow that one tick by tick. All right, yeah, so just a super, super strong day. We had a massive gap up this morning on the announcement of the China tariff pause. So we are bringing tariffs down from, I guess, 145% on China to 10% plus an extra 20% for the fentanyl stuff. About as good as you could get. And they're bringing tariffs down on us from, I think, 125% to 10%, which is basically where they were prior to all this. I saw a couple analyst estimates back earlier in the year that saw that the true China tariff rate on the United States products is somewhere between like 6 and 9% basically. So now they're at 10%. So they're almost back to where they were. Obviously, that doesn't address the fact that certain products that are United States products, the primarily intellectual products, I think, are just not allowed in the United States, are not allowed in China at all. But, you know, still like a big circle here on this tariff situation to go from kind of where we were to some crazy numbers to more or less back where we were. And the market loved it today. It really created a positioning squeeze to the upside. The gap up was huge. The intraday price action was relatively boring considering just how big that gap up was. We had a game plan to short the opening extension on an initial signal. Sometimes that initial signal is just like the opening bar begins to sell and you can be short versus the high of that opening bar. That was the case today. Other times the signal happens a little bit later because you can get like a bit of a positioning squeeze in the direction of the gap. Typically that doesn't last for more than 15 to 30 minutes. In rare circumstances it lasts longer. I've seen it last like a half a day in more rare circumstances before the roll off occurs. But today it happened immediately off the open. So that's what we were looking for the beginning of the day, was the extension short because the gap was so big. And the game plan on that we discussed in the morning meeting was to cover risk, cover more into equilibrium, and then maybe hold a little bit just in case that retracement back down becomes something bigger because there was so much extension on the daily chart at this point because the gap was so massive. 3% plus gap in the market. Prior to this calendar year, we didn't see those too often, really, since like COVID or maybe a little bit in the 2022 bear market. So you don't get those too often. But that gap was big enough to not just extend us on the 5-minute chart, but also extend us to kind of extreme extension points on the daily for both the SPYs and the Qs. So therefore, it made sense to look for that opening short, cover some quickly, get the risk covered, cover some more maybe into this ADMA on the 5-minute, or the IWM went all the way down to the 21s. Another good place to book some profit, and then hold a little bit just in case that retracement lower actually reverses lower, which was not the case. And I'm not surprised really to see it. The midday price action got actually extremely boring, and then we went into this never-ending bid that still exists for this market right now that held us up, brought us back up, enabled the SPYs to recapture 580, which it was trying to hold as resistance during the day. And then I had some data that I was sharing into the VTF that said that the MOCs were probably going to be pretty big buys, and that's what happened. We got the buy MOC into the close, we ripped into the last 10 minutes, and we closed at absolute highs. So here at the end of the day, we are trading around SPY 583 with the ADMA at 565. So we've got $18 about of extension to the upside. That's pretty extreme. That'll be less tomorrow because this ADMA will be working its way up. But we will almost definitely, unless we get a huge gap down, still be at extreme extension tomorrow morning. We closed well today. It technically makes today a day one to the upside, though extraordinarily difficult to chase. So I am not an advocate of new longs here. And in fact, I'm starting to think, and I was already thinking this a little bit last week, but now that so this China tariff number came out better than I think pretty much anybody on the street expected, and it really created a maximum pain to the upside. We saw Donald Trump last week tease maybe we'll bring tariffs down to 80%, and I said I said it in that moment, I was like, I don't know where we're going to bring them down to this weekend, but it's going to be lower than 80%. Like, I just feel like that is how he negotiates, where he's going to throw out this 80% number, keep that number high going into the negotiation, and then the number's going to be lower than that, and the market's going to move higher. Lower than 80%, absolutely made sense. 10% plus, again, the 20% for the fentanyl, I think is beyond the expectation of even most of the bigger bulls that were out there. We had looked at the Goldman note earlier in the week last week that said that the market was pricing in probably 40%. So anything less than that, the market should go up. We also looked at the JP Morgan note on Friday morning that said that a pause with China or anything less than a 50% tariff rate on China should bring the S&P up 3%. And here we are, lo and behold, up 3.3%. So JP Morgan research note at the end of last week was very, very spot on that news, which I think they only assigned a 15% probability of occurring, but it occurred, and we are up just a little bit over 3% as a result. So yeah, big update today. Though with this said now, and with this good news now, I am curious to see how the market reacts to future headlines related to the tariff war or any deals that get done. Because now that the China pause here is behind us, at least in the short run, I don't really see what else is out there, at least from the trade war perspective, that could be good news that's not priced in. Like, we know where the floor is now with every country after the UK deal, and this China thing happened significantly better than we expected. So I kind of feel like we're not going to see these really big up moves anymore on any real further deals. Maybe Europe, if Europe gets done, maybe, but I don't see Europe getting done anytime soon. It's just a lot of politics over there when you're dealing with a block of nations, right? It's not even like it's just one country. So we'll see how all that plays out, but I'm starting to think that the headline risk is becoming more to the downside. But with that said, the positioning risk is still to the upside, which is crazy, right? We still know systematics are buying this week. less than last week, but they are still buying this week. Into this move to the upside, you also get like an additional squeeze higher from like the leveraged ETFs. That's how we knew that the buy imbalance was going to be that way, and also from just like the more normal options gamma. So there is still a positioning risk to the upside. Like if you look at Pat's note from this morning here, look at this one. This Goldman Sachs. I've always found this to be the weirdest chart. They call it a sentiment indicator of positioning. Like which is it? Is it sentiment or is it positioning? Um, it's sentiment of positioning, but it basically indicates that there's very, very, very light positioning still. And that's kind of what I'm saying with this market. Like this this is like the most hated up move I feel like I've seen in a very long time. Anybody who's macro focused is bearish and really thinks that the risk is to the downside, and we just keep squeezing up. Part of it's coming from the positioning and systematic squeeze that we've been looking for over the course of the last couple of weeks. Part of it's coming from just a reduction of the left tail from these headlines, and no one's really properly positioned for it. So it just is really creating this positioning squeeze to the upside until something breaks, until some numbers get worse. And we do have some important numbers this week, but I think that the numbers this week are still fairly backwards looking, right? I want to see the main numbers in June that will really show us tariffs were on. We know tariffs were on in May. We know the de minimis exemption was gone in the beginning of May. What do the numbers look like in June? Uh, we'll see them in June. That are the main numbers, but that's still a while away. And at least for this week, today's only Monday. We got to get through the potential of another strong week that's just brought on by positioning, if nothing more. But at the same time, how do you chase this degree of upside extension? You kind of can't. So I feel like this market's been stuck between a rock and a hard place for a little while now. Last week, I think I had a great call that the forced systematic buying, which was massive, one of the biggest weeks ever, actually would run into enough positioning selling and extension selling that they would weigh each other out. So we actually had like a consolidation week last week, but technically that's bullish, right? We moved higher, we got extended, we pulled back a little bit, mainly went sideways. ADMA caught up on the daily. This turns into like a bullish consolidation, and now we're breaking above 570, which was a huge resistance level, and that bullish consolidation obviously broke to the upside. So 570 remains a huge level. If we ever test it again, we're very far away, so it's not something I'm necessarily looking for. But this market is blasting off in the stratosphere, and it's just really, really impressive turnaround. It's like someone said in the VTF earlier, I forget who. Like, imagine letting you know on just April 7th here, when the SPY was trading at 482 and it looked like the end of the world, that within about a month we'd be trading at in the 580s. Really just a crazy, crazy market. So I think that kind of covers it. For me today, it was mostly about. He did tell us to buy. I think it was on Thursday, Tom. He did tell us to buy on Thursday. He's 2 for 2. I was talking about that with Greta. He's 2 for 2 on saying, let's buy this market. The first time I really believed him too. I was like, oh yeah, like it makes a lot of sense down here. Second time I'm like, what could he possibly have in his sleeve at this point that really brings this market up for another huge leg like that? And I guess it was just this China pause being significantly better than what the market was expecting. So yeah, Trump is 2 for 2 on telling market participants to buy. Yeah, for me today, from a day trading perspective, I did very little. It was mainly about just managing positions. I was honestly very burned this morning by the degree of shorts that I had on. Just did not expect, I guess probably like a lot of the rest of market participants, just did not expect this weekend was going to go I thought it was going to go well. Like I thought we were going to get, a reduction while we continue to negotiate. Thought that number was definitely going to be less than 80%, but did not anticipate a 90-day pause bringing us down to as low as we did. And, I was pretty net short over the weekend, so took some pain, added up pre-market at really good prices, and honestly traded it pretty well. So I was able to reduce my negative P&L, but still, then with the rally back to close on highs, still ending the day with a decently nasty P&L, which just is what it is. Part of the trading business sometimes. And it was like I was saying, I think I had a pretty good interview with Greta today. Following your game plan is the key to the business. I really think that. You're gonna have down days, you're gonna have up days, you're gonna have really good days, you're gonna have some bad days along the way as well. But you can't allow. You're allowed to be upset when you lose money. You're allowed to be upset. I certainly am. We're human beings. You're supposed to experience emotion as a human being, but the key is to not act on those emotions. You need to act based on your rule set, which is manifested in the game plans that you establish for the trades that you put on, and that's all I can do. So I thought I did a really good job with that this morning, and it did help me reduce the degree of negative P&L that I had on the day, but certainly a tough one. And we'll just see how this market continues to unfold. I said it last week. I'm too early on the short side. I'm too early to be net short. And I still kind of think that, though. At these prices, is it possible for us to squeeze to 590 in the SPYs? I think so. I think that we're kind of approaching some degree of an upside cap here with the amount of extension we have, even with all the systematic buying that's out there. So that's pretty much all that I got. I'm happy to answer any questions that anybody has. From Liam, is that how you trade the open? Wait for a signal and follow the trend with your stop at the top or bottom of the candle, depending on long versus short? No, it's not necessarily how I trade the open. There's no trend. I mean, there's trends on the daily chart, but there's no trends on the 5 or 15-minute chart at the open. You're waiting for the trend to happen. The way that I trade the open is through gap analysis. Through gap analysis, what type of gap I'm dealing with, and the extension that gap is creating. So I have a whole gap class in my training program that I definitely suggest that you take a look at. And there's many names for many different types of gaps, but really what gap analysis boils down to is understanding what the gap is doing to the participants who are in the market. Are they putting people in the money? Are they putting people out of the money? And therefore, what are they most likely to do? Are they most likely to, into a gap up, sell because they're in the money and they're booking profit? Or in another situation that it's a good bit more rare, sometimes into a gap up, shorts are getting squeezed so hard that you get a gap and go situation. It tends to happen more with like a breakaway gap is what we call that, like a breakout that happens via the gap that puts people out of the money that really creates the squeeze. So that's pretty much what I'm doing. And today had nothing to do with trend at the open. It had everything to do with extension. So the way that I measure extension is where price is trading versus space between the 8 and 21 EMA. You can use that for any time frame, for any type of stock or market, and on multiple time frames. So coming into today with a 3% gap up, we went through this already. If we gapped up to 583 with the 80 EMA down at 5. I think we had like $16 of upside extension via the gap up. I'm just going off memory. And in the SPYs, and that is an extreme amount of extension. So already I'm not buying this market, that's for sure. The question is, am I shorting it? And if I'm shorting it, what am I looking for? And that degree of upside extension makes me want to short it. But I gotta look at the other pieces of information. So what's the small time frame doing? Well, the small time frame is going to be super extended also. If you get like a little baby gap of 0.2%, or less, you can't really do much with that. It's not big enough of a gap to create extension. When you have a 3% gap up, the SPY is opening at 581.50, and the 80 MA, though it will very rapidly catch up, is at 567. and you can see it rapidly catching up. But with gaps that big, it typically takes at least 30 minutes for the ADMA to catch up. So the question is, how is the market satisfying that extension? And there's basically a few different answers. One is it could become more extended, and that could happen with a positioning squeeze, right? Again, circling back to what I said before, if this gap up is putting a lot of shorts out of the money, then they're being forced to buy back the market. We are gapping up huge. It's creating a lot of small time frame extension, but the market can squeeze even further off positioning, and then you'll get even more extended. So that was one scenario we talked about in the morning meeting as a possibility, but that typically can't last. Like I said before, usually 15 to 30 minutes. So what I'd be looking for if there was a positioning squeeze at the open is some sort of a candlestick signal that the positioning squeeze is ending, and I have a level that I can on the 5-minute chart that I can be short versus, like an upside tail that I can be short versus. Another thing that could happen to satisfy this huge amount of upside extension is we could go sideways, and we could correct it through time. That's kind of the worst case situation. If you just go sideways and you're really tight and you're trying to short, you're not getting enough of a pullback to really make anything from it, and then eventually you're getting stopped out. It's just not the ideal one. It's not what you want, but it can happen. You could just go sideways, and then after 30 minutes or with a gap this big, maybe like 45 minutes to an hour of enough sideways price action, the ADMA on the 5 catches up. Or you could price correct, kind of the third choice. I'll add in like a 2.5 in a second. So like third choice is that you price correct. You gapped up really big, moving averages all the way down there. It's going to satisfy that extension. It pulls back really hard into the ADMA. That's the best case situation, because again, we're looking for that opening short. Whether that opening short just happens immediately off the open versus the opening 5-minute bar like it did today, or it happened versus a shooting star candlestick in the first 15 to 30 minutes, that's your signal to look for the price correction. That's what you're shorting for. You can't predict if it becomes a time correction and you don't make as much money. You can't predict that ahead of time. You don't know what type of correction the market's going to do, but you're going to get paid the most the bigger the price correction is. This situation today was kind of like scenario 2.5. It was a combination of a price and time correction. So we had an okay price correction. We really price corrected from this opening high of about 581.73 all the way down to the 1030 low of 577. We got what did I just say? 581.50, 582. So we got like a $4.50, $5 price correction to the downside. It's not terrible, but it could have been more. We went sideways for like a full 30 minutes here, and that let these moving averages catch up and reduce the reward profile over time of that price correction. So that's what I'm looking for in the beginning of the day. Short versus that opening high, cover some to get the risk covered, cover some more at the ADMA, cover some more maybe incrementally or with a little bit of a deeper pullback, keep a little bit in case that retracement lower becomes a broad reversal. It doesn't. You eventually get stopped out at the new high at 1 o'clock, but if you traded it properly, you make a few dollars on the trade. And it's a failed trade, by the way, technically, right? Because eventually it goes up past your stop loss. But it's a failed trade that you should have made money in because you executed it well and you understand the gap extension. So that's what I'm looking for at the open and how I'm trading it. It's not based on trend. It's based on gap analysis. Could you explain the squeeze from levered ETFs? So I can my best. I don't fully know actually the dynamics behind it, but you've got all these levered ETFs that are out there. Traditionally, they were in the indexes, the index ETFs like this SPXL that I trade a good bit of is a 3x bull ETF. The TQQQ is a 3x bull ETF. The TNA is a IWM 3x bull ETF. So that's leverage that's coming into the market. So that's going to have any buying that happens in a levered ETF is going to have an outsized impact overall on the S&P, right? Like if more people are buying these leverage ETFs in a day than selling them, that like kind of buy imbalance, for lack of a better term, that comes from the net buying of a levered ETF compared to the market has to be satisfied. I used to think that that was satisfied in real time, almost as like an arb opportunity. Like if people, and to some degree, I think it is. If people are buying a lot of T triple Q, like even if I buy 100 shares of T triple Q, that should have a moderate impact on QQQ in real time. Otherwise, there'd be an arbitrage opportunity. And those types of arbitrage opportunities don't really exist anymore because you have HFT robots that immediately take advantage of them. But apparently, based on a lot of the research that I was reading, a lot of that gets satisfied what the imbalance of buying and selling in levered ETFs, which might even have something to do with like a creation redemption type of thing for them. I'm not 100% sure. Gets satisfied at the index level into the close, so it can create a lot of end of day buying or end of day selling. So basically, I was reading a research report during the day today that came out during the day, and I copy and pasted twice into the virtual trading floor an important piece of information that I was reading off of it, and I really wanted to make sure to post that because a pattern that we as a team have been looking at and taking advantage of over the course of the last week has actually been selling into the close, right? Because the systematic bid has been there all day, and then the systematic bid turns off in the last 10 minutes. The buybacks turn off in the last 30 minutes. So we've been getting these roll downs into the close. But what I read off this note, if I can find it for a third time, I just pulled the note up. Oh yeah, here it is. So what I didn't copy and paste, I was just kind of telling you guys, it was a little bit higher in the note where it said end of day rebalancing is set to be particularly sensitive to the performance of Mag 7, 8, mega cap tech, AI innovation set of the majority weight of assets, where it's really talking about. So it's talking about the concept of gamma, and that leveraged ETFs act as like a synthetic source of gamma. So it's not like normally the gamma in the market is coming from options buying and selling. But this is more like synthetic gamma that's coming from these leveraged ETFs that creates like an end of day rebalancing. The note goes on to say, and this is the part that I copied and pasted into the VTF twice, we're projecting that the current, at the time of them writing this, positive 3% day change through the close. So basically, if the market's up 3% through the close, we see $30.9 billion of buying across option dealer index hedging and leveraged ETFs, with an additional $11.8 billion of implied buying across single name Mag 8 stocks, with a cumulative estimated $42.7 billion worth of incremental buy flows today. And again, in the paragraph above that, what I just read is that's going to be primarily satisfied, it sounds like, through end of day rebalancing. So I was looking at that as someone who is, kind of stuck short today and added some shorts at pretty good prices pre-market and covered some of those on the way down. And I was like, damn it, like I really wish that I could get this rolled down into the close like we were getting on these previous days. But based on this data that I'm reading, not only does it not look like I'm going to get the roll down into the close, it looks like there's going to be a big bid. So at I don't remember what time, 3:15, something like that, I decided to buy a little bit of insurance on that into the close by buying these QQQ 0DTE 509 calls. I bought them for 12 cents. I did not care necessarily if they went to zero. If I was wrong and the market had a roll down like it had on 4 of those 6 last trading sessions and they went to zero because the market was rolling down and I was getting paid on those shorts, I was going to be fine with that all day. But and it's not a trade that I don't think I've ever done this trade before, so I'm learning. I'm learning. I was like, but this number I'm reading here is so massive, 42.7 billion of incremental buy flows today at the index level from these levered ETFs plus these Mag 7 stocks. I was looking at the market, which was trading at that point, and it rolled down a little bit first at 507. And I'm like, market's at 507. I can buy 0 DTE calls for 12 cents. If there's going to be $40+ billion worth of buying into the close, and I got these shorts on, like, why don't I just buy some of these Q calls for out of the money? Because how many times have we seen? I mean, even last week though, it was primarily to the sell side. The market move dollars all into the close. Like we've had some big movements recently in those last 10 minutes. So I was like, for 12 cents, it's just so cheap that and I'll get so screwed also on my shorts if I'm as short as I am and we rip into the close at 509. I was like, let me just kind of buy these as some insurance. And then of course, like kind of the worst case situation possible for me worked out. We didn't roll down, which would have made them go to 0 and pay me on my shorts. But we didn't rip to 509, where the insurance would have helped me. We kind of had a buy impulse in the last 10 minutes, but it was after a grind to lower right before that. So it was just enough for me to kind of get screwed a little bit more on my shorts into the close while lose money on those Qs. I knew that was a possibility too. So I thought about buying them at the money. And I was like, I just don't want to take on that much dollar risk for that many contracts. I would rather buy them out of the money. So whatever. That's what I did, and just kind of lost on both sides. But I think that answers your question. From David. Question regarding hammer capitulation buy setup. 1, are you placing a buy stop order for a target price to enter in on the trade, or a buy limit order at the ask on your platform? So on a hammer capitulation buy setup, so market is extending down. It's a counter trend trade. Market is extending down. Volume is increasing. You have a lot of extension. How am I buying it? I'm not buying it with a buy stop. And I'm not doing it with a limit order at the ask necessarily either. I'm just taking the offer. I mean, one way to take the offer is to use a buy limit at the inside offer, but I would rather just use like an uptick key, which is what I use to just take the inside offer. It's not a market buy, but it's got similarities to a market buy. It's got similarities to taking a bid and crossing the offer, which is what you're describing, but it's a little bit of a slower process. It just takes the inside offer. So that's how I buy it, and then I put my stop at the low of the candle at that point, the low of the tail. So part 2 of your question: when you see a high probability on the trade, do you mainly look for the candle on the 5-minute chart to trade, and do you typically trade it as the candle is forming? I'm not sure if this is, I'm assuming this is still related to the hammer capitulation buy setup. You mainly look for the candle on the 5-minute chart to trade. Yeah, so I mean, on whatever time frame I'm looking at, that setup that you're describing is a setup that you can look for in any time frame. It could be a 5-minute hammer capitulation buy setup. It could be a 15-minute hammer capitulation buy setup. It could be a daily chart hammer capitulation buy setup. It trades the same regardless of the time frame. So it's whatever time frame I'm looking at. And do you typically trade it while the candle is forming? That's a great question. So my answer to that is yes. I do typically trade it while the candle is forming. There's a risk reward to doing that though. So if you're doing it while the candle is forming, you're anticipating that hammer is going to be what that candle is. You don't know it's going to be that way. So I don't think necessarily either of them is wrong. Most of the time when I do it, I'm doing it while the candle is still forming, not after it closes. If you wait till after it's closed, you've got confirmation that the candle's there. And you can come in and you can buy it, and you can put your stop at the low, and you can work your trade. You got confirmation, and that's fine. I call it cheating. If you cheat on the trade, which means that the candle hasn't closed yet, you could run into trouble, and I have. because you think that it's going to form this hammer capitulation setup. You think that's going to happen. You anticipate it. You cheat on the candle. You buy it, and you're wrong. And that candle closes on lows, and it hasn't hit the point where the setup is even there yet, and you're taking a loss on a trade that never even happened. The flip side is sometimes when you anticipate it, you can get better pricing. If you get better pricing, you get a better risk reward. Sometimes the tail of the candle can be so long that the trade's not even worth taking after it closes because the risk reward's not good and you had to anticipate in order to get the trade at all. So it's give and take a little bit on that, on what the right thing is to do. I tend to anticipate it, but sometimes you can get hurt for it and lose money where you would never have lost money because the trade never actually set up. If so, is there enough time in the trade based on your experience to calculate the number of shares to buy as the candle is forming? Yes, you just got to get faster at your math. That type of math, when you get good at it, trader math should be instantaneous. Like you need to internalize that trader math. Trader math is, every scenario of I want to risk $100. It's currently this many cents risk. How many shares do I buy? You need to know that. I mean, the way that I kind of do it is I just know, like, I know the important numbers, right? I know that, like, if it's 10 cents, I want to risk $100, it's 1,000 shares. If it's 25 cents, I want to risk $100, it's 400 shares. If it's 50 cents, I want to risk $100, it's 200 shares. Okay, so if it's 17 cents, then I'm probably just going to take 600 or 700 shares. It doesn't have to. I'm not in the business of exacts here, where everything is going to be perfectly the $100 that I want. Give and take. I wanted to risk $100. I risked 90. I wanted to risk $100. I risked 110. That's kind of the way that I do it. Is I know the math on the whole numbers, and then I just round about what it would be approximately, and I take my shares. You need to be able to do that instantaneously. I can look at a chart, know if I want to be in the trade, do the math on how many shares I need to buy it, get the stop loss in, get the offers in, do everything I just said, significantly faster than I'm able to say it. Within seconds. Because it might look like a person might miss the entrance or possible opportunity of the trade if they are trying to calculate the number of shares to buy based on the risk of that trade if the stock is moving. No. Forget it. No. Get better at the math. Get faster. This is not a matter of the trader. This is a matter of you being good and fast. That's it. It's not a matter of the stock is moving and I can't calculate the math. No, you need to get faster. That's what it comes down to. Part 3. How often does this type of trade setup occur based on your experience? Yeah, I don't know. I can't give you like a X amount of times per week. It's not a trade that happens significantly often, to be honest. And it happens less now than it used to, for whatever reason. We talked about that on an afternoon meeting when we saw that trade occur in Amazon at some point in the last month or two in an afternoon meeting. The hammer capitulation, that heavy hammer capitulation setup, capitulation in the market just doesn't happen the way that it used to, or as often as it used to. I just think that that's because the market's smarter than it used to be. But yeah, I don't know. But it's a good one to have in your playbook to recognize it. Are we looking at JD earnings tomorrow? Of course we are. It's tomorrow morning. Do you think you could go over the RDR trade? Yeah, so the RDR is it stands for Red Dog Reversal. We have like 4 different names for this trade. Traditionally, it was called an 80-20 trade. And Scott Redler decided to rename it after himself because it's a trade that he really likes and he's got a big ego. So he renamed it after himself as the RDR, the Red Dog Reversal. And then people thought that was funny, so sometimes you'll hear it called a DOO in the VTF every once in a while. Which stands for Derrick Oldensmith Overthrow, because you guys decided to rename the renamed trade after me instead of Redler. So it's all the exact same thing. Basically, it's just a version of a it's a mean reversion trade, right? So uh, the requirement of the trade, and traditionally it's for daily charts, but I actually started using this a couple years ago on like 5 and 15-minute charts as well, and I like it in certain scenarios. But basically, the trade setup requires you to have at least two or more big days in a row, big up days or big down days. What's going to happen if you have two or more big up days or big down days in a row? That stock will be what? That stock will be extended, right? Extension comes from large moves over short periods of time. So if you've got, like with the case of this QBTS, where we're looking for an RDR today, or PONY, where we're looking for an RDR today, you got two really big up days in a row. What did that do? It made the stock extended, right? At highs on Friday, the high was $11.68. The ADMA is at $9. So we're looking at a $9 stock that's got $2.50 of extension at highs. The RDR comes into play on that day 3, or if there was day 3 was really strong, it could come in on day 4. If day 4 was really strong, it could come in on day 5. And basically, what the trade is you need the stock to trade above the previous day's high. So it forces out more shorts, squeezes out more shorts, maybe chases in some silly chaser longs, and then trades back through the previous bar or the previous high of that candle. And the trade execution is to short through the previous high with the stop loss as the day's high thus far. So yesterday's high is $11.68 for QBTS. This morning the stock gaps above it, and in that first 5-minute bar, this one worked out very perfectly. It doesn't always work out this well, but you short back through $11.68 versus the high of that daily candle so far, because in this case it's a daily candle that you're trading off of. So in this case, you'd be shorting $11.68 with a stop at the high of the day is $11.84. I would use $11.85. And in this case, you've got 16 cents worth of risk. The reward potential on the trade is the ADMA on the daily. So you've got 16 cents worth of risk for, in this case, $2.80 worth of reward. Pretty good risk reward on that trade. That's traditionally what the RDR is, and it can be on either side. This happened to be an RDR to the downside. It can also be to the upside. The problem with what I just described with doing it on a daily chart, which is how it was traditionally taught, is that sometimes the risk is just really big, and then the risk reward isn't that fantastic. This one, like I said, coincidentally happens to be like an ideal situation. Phenomenal risk reward on where you're executing versus where the stop loss has to be versus where it can get to on the daily chart. Triggers perfectly in the first 5-minute bar of the day. Like, this is like as perfect of a situation as you can get on the trade, to be totally honest. A lot of times they don't work out that perfect. So a lot of times what I end up trying to do is, and this is a lot of my philosophy in trading, by the way, is small time frame risk for large time frame reward. Instead of waiting for it to truly trigger through that daily high, where let's say the high of the day today was actually $13 and not $11.84. If it's $13 and you're waiting for it to trigger $11.68 and then you're shorting, you're taking on like $1.35 in risk on an $11 stock. It's just way too much. So I would want to anticipate by finding something on the small time frame that gets me shorter at a better price, but recognizing that if it gets through 1168, it's triggering that daily chart RDR, and I can get like a really good RDR reward for like a different type of trade risk on a 5-minute chart. That's a lot of times the way I do it. And now, more regularly, over the course of the last couple of years, I've been kind of doing the same pattern at certain spots on like a 5 or a 15-minute chart. on a 5-minute chart, if you try to like short after every third strong bar, you're probably gonna lose money. So you really got to implement those other layers of probability and everything else on those small time frames and extension and everything else to really say like, all right, I'm going to use this as an RDR opportunity on a 5-minute chart because I like all these other things. But that's what that is. I mean, so the pony is a good example of it not being like as good of example, right? The QBTS was perfect. Pony was tougher. Granted, this first 5-minute bar of the day, is so strong that you now have your trigger, and the trade works. But this is an example of why I don't necessarily do that daily chart execution. You'd be shorting on the third 5-minute bar of the day on the break of $12.22. Sorry, $19.22. But you'd have to give it all the way up to $21.29. And I also don't like this execution spot on the 5-minute chart. It just price corrected all the way down to the 80 band of the 5, and you're shorting it now. That's not good. Technically, it never would have stopped you out, and technically still has a lot of room to work on the downside. But this trade today didn't even give you 1-to-1 on your risk at its best point. Not even close, right? At its best point, you were shorting, what did I say this high was? 1922, and the low, at best throughout the day, you were 20 cents in the money, risking a couple dollars. That's no good. And I don't really see a great opportunity here on the 5-minute chart where I really would want to short this for the example I was talking about of trying to find something on a small picture to execute the big picture. But the concept is there on the daily chart, right? This is a day 1, 2, 3, 4. This is day 5 to the upside. This is a day 5 RDR. I like that. But as you've probably heard me say in the past, a lot of the trade ideas that I write down on my list in the morning never properly trigger, and I don't actually trade them. Those are potential trading ideas based on pre-market research. Sometimes they trigger great. Honestly, like the Palantir short was fantastic this morning. The QBTS short was fantastic this morning. And the NVIDIA short was decent, and the pony as a RDR setup wasn't good at all. But a lot of times I write down, I look at 100 stocks, I come up with 7 ideas, and 2 of them are really tradable. So yeah, I think that answers your question. Where can you find Pat's note? It's in the alerts section of the VTF as a Google Doc every morning, somewhere between 8:30 and 8:45 usually gets it out. From Eli, I wanted to share, I work with some psychologists revolving around emotions and trading. They've mentioned that emotions are like a valve. They need some sort of release. It manifests one way or another, so you have to create an outlet for yourself that works best. It can be writing, talking out loud, maybe something physical, not just allowing it to manifest the energy to get you to click the mouse. Just find something that isn't touching your execution system. Yeah, love that commentary there from Eli. Really appreciate you sharing that. I love getting a good workout in after a frustrating trading session. And then for me, like I was saying a little bit on the podcast thing with Greta earlier today, I think that the best counter to almost any trading psychology issue that any trader will come across is good game planning. And it's like I said with Greta, it's not that I don't get upset. I get upset. I sometimes get really upset. I have huge P&L swings. This business is stressful. I try to be as professional as I possibly can on the radio at all times, but especially sometimes if the radio is off, I yell, I curse, I punch the desk. Like, those things happen. The biggest key for me is not that those emotions aren't going to happen. They're going to happen. It's not ever acting on them. And the key to me not ever acting on them is to really believe in the game plans that I have established for my trading and follow through on those game plans no matter what. Because it's so easy to get in your head in this business. If you believe that your game plans are a manifestation of your rules, which define your edge in your trading, then you will follow those rules to the bitter end, because that's how you actually make money. and it doesn't matter how you feel or what emotions you're going through or anything else. So appreciate it, Eli. Appreciate it very much. All right, cool. Covers everything in the VTF over on the YouTube. Kevin G giving me a hard time for not usually starting on time, and I did it as a blooper by accident. From Robert, expectations from light and higher CPI tomorrow. So I don't know. I'm not expecting necessarily a huge reaction on the CPI because I think it's just a little bit too backwards looking. Though we will have a reaction. I think a hot CPI will be looked at particularly bad because it's like, oh man, we're seeing the inflation come in hot and we're not even seeing the totality of tariffs on the number yet. That's not good. CPI coming in light, it's definitely, I think, a good news is good news and a bad news is bad news situation. But maybe the risk is actually to the downside on a higher CPI compared to a lighter CPI. A lighter CPI is just like, okay, it's kind of more of the same, right? Like, all right, it's good. Prices are holding lower. That's good. But we haven't seen, the data's old and we haven't really seen the tariff impact yet. So as I say that out loud, I kind of think that the risk is to the downside, where a high CPI could bring us down more than a light CPI could bring us up, just because of the implications there of, oh wow, things are getting bad just in anticipation before we even see those tariff numbers hit. But if the number comes in light, it gives the Fed a little bit of leeway to say, like, okay, we're in wait and see mode, but that number came in light, so if unemployment starts to pick up, we could cut a little bit earlier. So that would be the bull argument, but I think that bull argument is muted just because of what I said. I think you really need to see the May numbers in June. If you get a light CPI compared to expectations, or just light even generally speaking, in June on the May numbers, that starts to give the Fed an all clear signal to cut rates if they see growth declining. Yep, I think I answered that one already, Joel, but thank you for asking. From Gabriel, what do you make of the TLT move? Not worry about it until we lose your lows. Yeah, we got to pay attention to 4.5% on the 10-year. It seems to be like a spot where if we get below it, it could start to have some negative repercussions on the equity market. Generally, though, I think the TLT move lower today was just a signal of fear reduction in the market. Like, we got through this, we got this China pause, and that's great. We're working things out. The gold can come down. People who bought TLT as a safety trade can sell it down, and the stock market can move higher. If that leads to a genuinely bigger increase in rates, we could start to have a problem. Gabriel's saying, I have a post-it note in my screen with share sizes according to the risk level. Also, you end up memorizing the share size. That's something you could do while you're in learning mode for your trader math, is maybe make a cheat sheet with a piece of paper or some post-it notes. So thank you for that idea there, Gabriel. All right, folks, just after 5 o'clock here, I'm going to wrap up the meeting. I hope everybody had a great day, and I will see you all tomorrow.